Topic 10, and we're looking at exchange rates. And in this case study, we're looking at the euro. But before we do that, let's just remind ourselves that there are three main types of exchange rate regimes. The first one is a floating exchange rate regime, and that a good example of that is Australia. So the exchange rate is free to move up and down and respond to the forces of demand and supply. The second one is a managed exchange rate system, and a good example of that is Singapore. The main feature of a managed exchange rate system is that there is some intervention by the central bank to control movements in the exchange rate. And typically what we see across most countries that have managed exchange rate systems is that intervention is to prevent what economists call overshooting. That is the exchange rate appreciating too much or the exchange rate depreciating too much. So sometimes there can be a little bit of intervention to prevent that from happening, or in the case of Singapore, intervention to control the exchange rate movements to keep it within an upper and lower band. And then the third is a fixed exchange rate system. And generally, fixed exchange rate systems are adopted by smaller countries, developing countries, rather than mature, larger economies. Generally speaking, countries that start off as fixed exchange, or the countries that start by using a fixed exchange rate system, eventually do move to a floating system. So with that in mind, let's move on to the euro. So the euro currency was introduced in early 1999, and then notes and coins began circulating in 2002. So I've got a list of some of the countries there that have adopted the euro. Interestingly, the UK, Britain, stayed out of the euro. It really wanted to retain its own monetary independence. And what I mean by monetary or retaining its own monetary independence will become more obvious as we move through this case study. Okay, so what are the benefits of the euro? So leading up to the introduction of the euro in 1999, thinking back, it must have been a good sort of 3, 4, 5 years. There was obviously the concept of the euro emerged sort of decades prior to 1999, but in the 3, 4, 5 years or so leading up to the introduction of the euro in 1999, there was a lot of debate and analysis and research that went into the euro currency. And out of a lot of that research, there were a list of potential benefits of the adoption of the euro generated. And I'm going to go through some of the main benefits of the euro that were being discussed back then, prior to the introduction of the euro in 1999. So I've got a list here. The first one is greater price transparency. So let's take a step back. The whole idea of the euro was to develop greater integration within the European area. That is, greater integration at the economic and financial level. So the idea was, if policymakers, politicians could get the countries of Europe using a common currency, there would be greater trade flows and greater investment flows. So trade flows should make sense to you. And I'll go through why there should be greater trade flows as a result of this very soon, but also greater investment flows. So we've already looked at, in this course, we've looked at money moving between countries, buying bonds, shares, real estate. The idea was that that would be enhanced more by the adoption of a common currency. So countries which had excess savings, for example, would be able to more freely lend that money to countries which have a savings investment deficit. So that's the basic idea. More trade, more investment, and just a greater sense of integration within Europe. So let's go through these main benefits. The first is price transparency. So just imagine you are living in Germany, and prior to the euro, you were using Deutschmark. But Germany is surrounded by a number of countries. And so you do have options in terms of where you buy certain goods or services. But prior to the introduction of the euro, one of the main problems was currency conversion and the cost of currency conversion. So it might have been the case that you could buy, living in Germany, you might have been able to buy the same car slightly cheaper in France, but once currency conversion costs are taken into consideration, that may have actually wiped out the price differential and any incentive to actually purchase that cheaper car in France. Of course, you can't purchase everything that you buy in another country. So for example, if you get your hair cut every month, every 2 months, every 3 months, you're not going to cross the border and get that done to save a few dollars. So we're talking about purchases of more substantial goods or services here, where the price saving is potentially motivation to actually go to another country and purchase that particular good. So greater price transparency, because the idea being all the countries in Europe would be using a common currency, that prices of goods and services would be expressed in that currency. So you could more easily compare, if you were in Germany, for example, the price of similar goods in other surrounding countries. That was meant to boost competition among businesses, and really that's going to benefit consumers by keeping prices low. If that could be achieved, point number 2, greater price competition and inability for companies, I guess, to gouge the consumer because of the greater price competition, inflation rates are likely to be lower. And with lower inflation rates, we know that we have then lower interest rates, because nominal interest rates have an inflation component built into them. So the idea being greater competition in the sale or the provision of goods and services, chances are those prices will rise more slowly over time. Lower. Okay, the next one, the third one, is it just removes transaction costs associated with the buying and selling of foreign exchange. So many of you will have been on an overseas holiday. One of the first things that you do when you go to the airport is buy some of the local currency that you're intending to use on your holiday. Or you may be using your credit card and paying for purchases that way. Either way, your bank will charge you a fee for currency conversion. And so this is one of the major issues of traveling around Europe. I certainly did travel around Europe in the early 90s, mid-90s, and back in those days, you were forever having to purchase new currency of the country that you just entered. And that has costs associated with it. So rather than purchasing one large amount of euros, you were having to buy Italian lira, French francs, German Deutschmarks, etc. And it just became very, very costly. And those costs then fall on the shoulders of consumers. And so even if we take a simple example like that of holidaying across different countries in Europe, a common currency is just going to make it easier and cheaper. The same for business as well. Businesses will be buying and selling goods and services across countries. Having a common currency just reduces or eliminates those transaction costs. The next one, improved economic stability and growth. The idea was if the countries of Europe were all using a common currency, they would create a larger economic zone, and that would then promote all sorts of economic benefits. Economies of scale being one of the most obvious, but also it would improve investment flows, technology transfer, all of those sorts of beneficial things which can then drive economic growth, and also improved economic stability. The idea there being that if, for example, Germany was booming, whereas Italy was in a recession, then the greater economic integration would mean that Germans would be more likely to be purchasing goods and services from Italy. And that is going to then help the Italian economy out as it sort of moves towards recession. Next one, better integrated and therefore more efficient financial markets. Okay, so I've already been through the idea of more integrated financial markets. That is, think of that as money moving between the bond markets and the stock markets of different countries more freely. Money is then able to search for the best returns. And it's going to also make financial markets as efficient as possible. And think of efficient financial markets as providing, in the case of bond markets, low and fair interest rates to all of the countries all of the countries that have adopted the euro currency. Next one, obviously greater influence in the global economy. And then also a tangible sign of European identity. So what I want to do now is go back to the third last one, more efficient financial markets, and have a look at what impact the adoption of the euro had on European interest rates, which I've got here. We've got 10-year yields on government bonds, or really yields on 10-year government bonds. And the introduction of the euro occurred at the beginning of 1999. And what we can see is the disparate interest rates that existed prior to the introduction. So Greece was a standout. In 1995, it looked like Greece's 10-year yield was about 19%. Then over the next 4 years, that interest rate on 10-year government bonds in Greece fell from around about 19% down to 6% at the beginning of 1999. So obviously, this is a visual on the incentive that the Greeks had to join this common currency. Interest rates on German government bonds came down from around about 7.7% down to around 4%. But we can see that the disparate interest rates that existed really merged into one apart from the Greek interest rate by early 1999. It took a couple of years for the Greek interest rate to fall to the level of interest rates in the other countries. And then from around about sort of 2000, 2001, right through to the global financial crisis in 2008, going into 2009, all of these countries enjoyed the similar very low interest rates on 10-year government bonds. So the governments of these countries were certainly benefiting from the introduction of the euro in the form of lower interest rate payments on their debt. And so it's interesting to ask, well, why did this happen? Prior to 1999, there were huge spreads between interest rates. But by about, as I said before, 2001, that had all but disappeared. Well, to understand this, you've got to ask yourself, well, First of all, why did the spread in these interest rates disappear? And it comes down to the elimination of risk. So if we have a look in 2003, interest rates in all of these countries were about 4%. And I look at that and I interpret it the following way. International lenders that were lending to the governments of these countries in 2003 and all of the other years, sort of 2001 onwards, I'm just picking out 2003 as a representative year, but international lenders were viewing the bonds of all of these countries as equally risky. Whereas in 1995, international lenders were viewing German government bonds as the lowest risk and Greek government bonds as highest risk. And what I'm assuming here is most of the difference in these interest rates prior to 1999 was a result of differences in risk. Now, not all of the interest rate differentials prior to 1999 would be due to differences in risk, but a large part of these differences would be. So when we come to move forward in time to 2003, international lenders have driven these interest rates for all of these countries to the same 4%. So international lenders basically saying they're indifferent between lending to Germany and Greece. So all risk must have been eliminated. So then to understand that, the next question is, well, what is the form of risk in terms of purchasing government bonds? What type of risk exists across these different countries? Well, prior to 1999, if you were buying German government bonds as an investment or Greek government bonds as an investment, as the investor, you would face two major forms of risk. The first is default risk, and the second was exchange rate risk. Default risk is just the risk of the government of the particular country that you have purchased bonds from defaulting on a coupon payment or the face value of the bond if the bond matures while you're holding it. That's default risk. Exchange rate risk occurs when you purchase, say, a German government bond using Deutschmarks and then hold that bond for a certain period of time. And then at the point where you then need to sell it, the exchange rate, the Deutschmark exchange rate, has then dropped in value or depreciated. If that happens, you'll then make a capital loss. So default risk and exchange rate risk are the two main forms of risk when you hold government bonds. Now, obviously, the adoption of the euro eliminated all exchange rate risk. So prior to 1999, this graph is saying to us that international investors believed that there was more exchange rate risk in holding Greek currency than the German Deutschmark. That makes sense because back in the sort of prior to 1999, the German Deutschmark was a very powerful currency. And I mean powerful in terms of stable. It was stable because it was always in demand, and it wasn't subject to wild swings Whereas the Greek currency, the drachma, was certainly nowhere near as strong as the German currency. So it's prior to 1999, this graph is telling us that there was apparently more exchange rate risk and also more default risk associated with owning Greek bonds. Introduction of the euro in 1999, all of the exchange rate risk has disappeared because all of these countries have adopted the euro. And so that's just disappeared. But this graph is also indicating that default risk by the governments also came into line. So this graph is now saying in the early 2000s, international lenders believed that the default risk of the German government was the same as the default risk of the Greek government, which looking back now seems crazy, because after the 2008-2009 global financial crisis, there was the European debt crisis. And you can read up on what happened to Greece during that period. But the Greek government did default on its bonds. I don't want to get too much, I don't want to go too far into the European debt crisis and the global financial crisis, but we can see that after the global financial crisis, the European debt crisis then hit in around about 2009, 2010. And the interest rates really began to just open up, the spread increased. Now, there was no currency risk because all of those countries were still using the euro currency. So it must have been default risk that the markets were then worried about after the global financial crisis. But the most interesting thing for me is how financial markets believed from around about 2001 right through to 2008 that the default risk of Germany and Greece was identical. It's quite extraordinary in hindsight. I think the belief back then was that with Europe now being closer from an economic and financial perspective after the adoption of the euro, that the whole zone was now stronger, and that Greece had virtually no chance of ever getting into economic trouble, to an extent where the government needed to default on its bonds. And if it did ever head in that direction, investors were probably thinking that Germany or Greece had the strength of Germany and France to potentially assist it if it ever got into fiscal difficulty. Okay, so that's the story of interest rates. But you can see that this is one of the major reasons that countries like Greece, Portugal, Ireland, Spain, and Italy were motivated to adopt the euro currency. There would have been billions and billions of dollars saved by the governments of these countries as interest rates were forced down to this common rate after 1999. Okay, so what I haven't told you so far is that when a group of countries use a common currency like this, the concept of an optimal currency area becomes relevant. So an optimal currency area is a geographic area like the countries in Europe that use a single currency, but there are actually conditions for the geographic area to be an optimal currency area. So what we're going to do is explore this idea of an optimal currency area and look at the 4 conditions that exist for a geographic area to qualify as an optimal currency area, and see how many of those Europe satisfies and compare that to how many Australia satisfies. Australia is an interesting case. In Australia, we have different states, but we all use the same common currency. So what I'll be doing in the rest of this case study is arguing that the euro currency has caused major problems for the countries of Europe. And in comparison, Australia has used a common currency quite successfully. And I'll explain what I mean by that. But the question I will be asking, and the question I'll be answering moving forward, is if Australia has very successfully used a common currency across the various states and territories with very minimal problems, why were the European countries unable to replicate the success that Australia has had in adopting a common currency? So that is one of the big issues that will come out in the rest of this case study. Okay, so a couple of dot points for you to have a look at there. I think they're fairly self-explanatory. Number 3, countries must share strong economic ties to benefit from a common currency. The idea in Europe was that those economic ties would actually strengthen. It facilitates trade and integrates capital markets. That should make sense to you now. But the final point is interesting and one that I will expand on. A common currency results in a loss of each country's ability to direct fiscal and monetary policy interventions to stabilize their individual economies. What does that mean? Well, in Australia, we have, across the various states and territories, a common monetary policy. So we have one central bank setting interest rates for all of Australia, and we have a common fiscal authority, the federal government. Yes, we do have state governments that tax us and collect revenue and spend that money, but we also have a common fiscal authority that is the federal government. And so this is the question that I want to throw at you to get you thinking about this issue. If Australia, just imagine the various states and territories in Australia, if we continued to use a common currency, could each state of Australia have its own monetary policy? That is, setting interest rates, different interest rates across the different states and territories. And could each of those states and territories have its own fiscal policy? Is that possible? Well, the answer to the first question is, and remember the first question was, could Australia's states and territories have different monetary policies? The answer is yes, it's possible, but only if you wanted to fracture Australia and really separate out the different states and territories. The problem being, if the various states and territories of Australia adopted separate monetary policies, but you also wanted the states and territories to remain integrated at the trade level and at the financial level, it would be impossible to do. So let's just play out that scenario. You're now King of Australia, Queen of Australia, the supreme ruler, and you want to, don't worry about why you want to do this, but you want to maintain integration of the various states and territories in Australia at the level of trade, at the level of investment flows. But at the same time, you want each of those states and territories to have its own monetary policy. So to potentially set different interest rates. What I'm arguing is that that's impossible. So why do you want different interest rates? Why do you want each state to have its own monetary policy? Well, one response you could come up with is that perhaps we would be in a situation where Western Australia is booming because of the mining boom, and we could then set interest rates high in WA, but maybe at the same time, New South Wales was suffering because of a drought, and we can therefore set low interest rates in New South Wales. And we could tailor-make interest rates across the different states and territories for economic conditions in those states and territories. Sounds good initially. But the problem with that is if you want to then maintain integration of the various states and territories, you would need to prevent borrowers in WA who are subject to higher interest rates from going to Sydney and borrowing at their lower interest rates. Hopefully you can see the problem. So you would need to, at a financial level, at an interest rate level, you would need to fracture Australia and stop Australians from going to states of Australia where interest rates are lower. So really, you can't have integration of the various states and territories of Australia and separate monetary policies. And that should be obvious now. And that's exactly why we have one central bank and one monetary policy in Australia. So coming back to that final point on the slide, a common currency like we use in Australia, results in a loss of each country's ability, each state's ability, to direct fiscal and monetary policy interventions to stabilise their individual economies. Don't worry about the fiscal aspect. I'm just focusing on the monetary policy aspect. So if you have a group of states or a group of countries that use a common currency, they cannot have different monetary policies. They're using the same currency. You want them to maintain their level of integration, so you have to have a single central bank setting a single interest rate for the whole geographic zone. The only way you could have different countries using and setting different interest rates on the same currency is by totally fracturing those countries, separating them, and preventing financial flows between those countries. When I say financial flows, I'm thinking of lenders in the high interest rate country borrowers in the high interest rate country borrowing from lenders in the low interest rate country. You would have to stop that completely. So in this case study, we have another 2 slides to work through. And what I'll do is create a separate video addressing those last 2 slides.